Taxes aren't just something that you do in April. They should be something that you consider all year round. And if you're a content creator who is beginning to generate revenue from your channel, it's important to not wing this part and start treating tax planning like a business strategy. So today, let's talk about how to prepare for taxes versus just react to them, and some ways for creators to potentially lower their tax bill. But before we begin, let's kick off with a quick disclaimer. This video provides general financial education and is not personalized investment, legal, tax, or other advice, nor is it a solicitation for advisory services. The strategies discussed in this video may not be suitable for your personal situation, so please contact a qualified professional for advice tailored to your specific, unique situation. All right, we have a lot to cover, so let's dive in. Tip number 1, separate your money. This means open a dedicated business checking account. I'm a big proponent of clean financial records. They are the foundation to your financial life. Without organization and tidiness whenever it comes to financial records, trying to create any semblance of control is kind of pointless. This means that income goes into your business checking account, expenses go out of your business checking account, and your personal accounts stay completely separate. This is your first defense in the case of an audit, and your first offense whenever it comes to actually figuring out strategies to be able to minimize your expenses and your tax bill. Tip number 2 is to track every single dollar. It means using software like QuickBooks or even an Excel spreadsheet to be able to track all of your income, all of your expenses, and categorize all of those. Make sure that you're tracking all income from all sources. So this could be YouTube AdSense, this could be Twitch, this could be merchandise, sponsorships, affiliate revenue, Patreon, whatever revenue that you have coming into your account, you need to be logging. And then on the outflow side, this would be all business expenses. So things that you specifically use for your business. Tracking all of your income and expenses like this makes it easy for your CPA to file your taxes, and it also speeds up the process in the case of an audit. It's also helpful to occasionally look through all of your expenses to determine whether you need all of the software that you're currently paying for. There's no reason to continue to pay for things that you don't actively use or need for your business. Tip number 3 is to save for and pay your quarterly estimated taxes. As a self-employed content creator, if you expect to owe the IRS more than $1,000 in a year, then you are expected to pay in quarterly estimated taxes. And you have to pay those 4 times a year: April, June, September, and January. My suggestion is to set aside 30% of your profits in a dedicated account called taxes. That way, every quarter, whenever you are doing your quarterly filings, then the money is already there and you're not scrambling trying to figure out how to pay your tax bill. Also, another pro tip here, if it's any substantial amount of money, it might be helpful to set aside the taxes into a high yield savings account. That way you can earn at least a low amount of yield on the money that you have set aside for taxes. Okay, now let's switch gears a little bit. How do we actually reduce the amount that we would owe in taxes? This is where write-offs, structure, and retirement accounts can be used. So tip number 4 is to use every legitimate write-off that you can. A few of the items that I have written down that you could already be deducting is equipment and gear, software and subscriptions, a portion of your home office, a percentage of your internet and phone bill, payments that you make to contractors, think video editors, travel for business, education and training, marketing and promotion of your channel, and meals that have a business intent. Now, on this last one, you can't deduct the entire meal. It's a 50% deduction, but hey, it's still something. Also, please note that some of these deductions can change from year to year. So it's critically important to consult with your CPA to ensure that the things that you are attempting to deduct can legally be deducted. We don't want to get into any kind of situation where you're receiving penalties and fines for trying to deduct something that is not deductible. Tip number 5 is to consider structuring your business as an S Corp, or if you are structured as an LLC, electing for S Corp taxation status. This varies from creator to creator. Typically, it makes the most sense whenever you are earning at least $80,000 to $100,000 a year. And again, this is something that you will want to speak with a CPA before making this election. An S Corp, or electing S Corp taxation status as an LLC, allows you to take a reasonable salary and then take additional profits as the owner as distributions. As a sole proprietor or an LLC, you end up paying self-employment tax, which equates to 15.3%. This covers Social Security, Medicare, and Medicaid. An S Corp, or an LLC that is electing to be taxed like an S Corp, allows yourself to pay yourself a reasonable salary and then take additional profits as an owner's distribution. Now, on the reasonable salary, you still have to pay the 15.3%. On the owner's distribution component, you don't have to pay the self-employment tax. So at a certain level of profits, an S Corp election could literally save you thousands of dollars just in self-employment tax. And keep in mind that the savings scale as your revenue scales. But before you just run out and elect S Corp status, just know that doing this too early could cost you a significant amount of money. The caveat to operating as an S Corp is that there are generally higher administrative costs. That means that you have to run payroll. You have to issue yourself a W-2 at the end of the year. You have to either pay your CPA or pay a payroll provider to handle all of this for you. There's added complexity and cost that comes with operating like an S Corp, and that's why you should be cautious not to do this too early. Tip number 6 is that you can deduct certain retirement contributions. Now, many creators that I speak to aren't even contributing to retirement accounts, and there's a little bit of confusion as to who can and cannot contribute to these accounts. But even if you are a solo creator, you can create retirement accounts for yourself and be able to receive tax benefits either when you're contributing to the account or when you're withdrawing from the account. Now, the 3 most popular retirement account structures for people who are self-employed would be like the traditional or the Roth IRA, a SEP IRA, or a solo 401k. Whenever you contribute to these accounts, you can actually deduct your contributions and lower your taxable income in the year that you make the contribution. On a really basic level, the traditional IRAs or the traditional 401ks, that means that you can deduct your contributions during the year that you contribute to them, but then you pay taxes whenever you withdraw from the account. A Roth IRA or a Roth 401k, on the other hand, means that you pay taxes on the amounts that you contribute. So if you contribute $5,000 into a Roth IRA this year, you pay taxes on that $5,000. But then at retirement age, when you start withdrawing, if that $5K turns into $20 or $30K, then you pay no taxes on the withdrawal at retirement. And so there are some major differences here. My suggestion is to work with a professional whenever it comes to tax planning and before opening one of these accounts. There are significant trade-offs involved whenever you are opening up one of these accounts, and it's important to not take this step lightly. Tip number 7 is to sometimes consider deferring your income. This would also be considered year-end planning. Once you start getting to the end of the year, then you can begin to more accurately project what your total revenue and profits will be. One thing that you could consider doing is accelerating deductions. So if you are looking to purchase gear, courses, marketing, or if you're buying plane tickets or lodging for a event that's coming up early in the next year, you could consider going ahead and buying those things in December. That way you have those expenses to be deducted in that year. Another option is to make donations to charity. If you're itemizing deductions, then there are very real benefits to donating to charities. So speak with a tax professional to see if that's something that could help. Kind of on this topic too, there's something called a donor advised fund where you can make a contribution or a donation to charity and then actually distribute that at a later date. And so if it's the very end of December and you need to make a donation to charity, then you could always make that donation. You can get the deduction at the time that you make the contribution, and then you can decide at a later date how you want to donate those funds. Tip number 8 is to keep digital records of everything. Now, keep in mind that your audit risk increases as your revenue increases as well. And so make sure that you're storing digital copies of your receipts. So copies of invoices for all of your subscriptions, all of the purchases and gear that you make, as well as your payroll information, 1099 information, either a spreadsheet or some other way of being able to track all of your income and expenses, and store all of that either in Dropbox, Google Drive, however you feel most comfortable storing documentation and receipts. Good records generally mean better deductions and an easier time for your CPA to be able to look through all of your information and be able to identify ways of being able to bring down your tax bill. Tip number 9 is to work with a tax professional, but I would recommend not working with just anybody, but find somebody who actually understands the nuances and the complex needs of working with creators. You want somebody who really understands digital revenue models, someone who can help you with write-offs for creative industries. They can help guide you to determine when it makes sense to move to S Corp election or S Corp status. And if you find someone who is good, they'll actually spend time with you, review your information, figure out how to reduce your tax burden ethically and without red flags. When you reach this stage, it's worth investing the time to build a plan, work with professionals that understand your business, understand your desires, and can help you reach your long-term goals. You've already learned how to generate revenue as a creator. Now the smart part is learning how to keep more of it. My recommendation would be to treat tax preparation and planning like any of your other business workflows. Make it proactive versus reactive. I know that was a lot, but it doesn't have to be super complicated. There are people that you can work with to help you create the structure and the process that you need that suits your business to make the most of the revenue that you're generating. If you found this video at all helpful, I would genuinely appreciate a like on the video and subscribe if you'd like to see more content like it. Also, what other challenges or topics would you like to see content on? Let me know in the comments or feel free to send me a message. I would love to hear from you. Otherwise, have a great week and see you all in the next video.